Hey guys, welcome to the prelude of episode 6 of Invest with Instinct. I am here in beautiful Carlsbad, California, just north of San Diego for a little bit of a staycation. Anyways, this week's guest is Jack Farley. You guys might know him as the host of Forward Guidance, a great macro podcast out there. I've known him from kind of back in the day at Real Vision when he was back there. Now he's at Blockworks and doing absolutely awesome work, and I figured it'd be cool to talk to him about how he thinks about things. And we get into the important things about we're all getting blasted with information out there, interviews, podcasts, articles, Substacks, and how do we process that? How do we think through where we're going to allocate our money based on our goals and our style? It's kind of what I'm trying to do here. Wow, look at that. Amazing. Anyways, if you do notice a little bit of audio issues, I tried to fix it as best as I could. It should be fine. You shouldn't notice much of it at all. But otherwise, enjoy. It was another great chat. See ya. All right, guys, welcome back. Invest with Instinct, episode number 6 now, and you might recognize this face on the right side of the screen, Jack Farley, the host of everybody's favorite macro podcast on YouTube, Forward Guidance. Still not sure what Forward Guidance means. I don't know if I ever really will. Jack, what's going on?
I appreciate the humility of you pretending to not know what it means, but you know what it means. I'm doing great, man. Thanks for having me. Good to be here.
Cool. So I just thought it'd be fun to get Jack on the other side of the camera and talk a little bit about him and the show. And I just have some interesting questions from a different perspective, maybe about the show and just information and how we perceive things and whatever. I thought you'd be a good guy to talk to. So first of all, I just want you to explain, like, who are you as like an investor or whatever, right? What are you? Do you invest? Do you just mainly find interest in the things you talk about? Like, what's your style? Like, what do you do?
So I do invest and I do trade. I'd like to think of myself as an investor, but oftentimes I'll change my mind. I probably change my mind too often, which I think is just somewhat common. Like the people who have often the best results literally just buy a position in 2009 and then they haven't sold it since, and they haven't even added or trimmed, or they don't do anything. So I probably work too hard as an investor on the trading side. I'd say a lot of it is single securities that I have interest in the business, and I've learned from mistakes of having a strong view about something where I don't know anything about the industry. But if I'm talking about financials or something in particular in the yield curve, and then there's something that catches my eye, if I press further on and it seems more interesting, then I may get involved with it. Often I say, oh, this looks interesting. I look into it. I'm like, no, it's too risky, or don't understand it, or something like that. And I think that's the new style of trying to do. Whereas in the old days, I'd be like, oh yeah, this looks interesting, buy it. This looks interesting, short it. This looks interesting. Oh, options positions, stuff like that. I feel like I'm trying to simplify, but yeah, I don't trade futures, but I do pretty much everything other than trading futures, I would say, or I have, and I'm not. That's very different from saying like I have succeeded doing all these styles, but I have done a lot of different styles for sure.
Yeah. So it sounds like over time you're starting to refine your process. You've gone through the whole, hey, get my skin in the game and just buy something because of one anecdote or chart or whatever it may be. And then over time you're kind of like, well, okay, maybe parts of that was a good idea. Parts of that was a bad idea. Oh, that didn't feel right to me at all. I don't even fucking like this sector. I don't even have any conviction or whatever. Like all these things you probably have worked through and kind of like started to narrow down what you're interested in actually making a move on these days.
Yes. And I'd say, fortunately, I never had the view of charts first. I make a lot of long-term charts to show stuff on like spreads and rates and stocks and relative performance and stuff like that. But I fortunately have never had the view of like, oh, this chart looks so bullish or this chart looks so bearish. I feel like people who say like, fuck me, that looks like a great chart, let's do, like, and that's the reason why they're getting involved. Like, I feel like long term they are going to get killed.
Yeah, I totally agree with you. And the thing is, you're putting yourself into an arena where you're just going to be getting blasted in the face with ideas, right? Because it's
Mhm.
literally,
Yeah.
I mean, it's literally your job to pull the ideas out of people, right? And to be like, how are these actionable?
So yes, but I think that someone who doesn't do what I do could be have as much exposure to ideas, like if they watch the financial news channels all day long, which I mean, I don't think there are people who like a lot of people who do that, but if people wanted to just get as much access to as much content, it's out there. It's just that I do it because it's my job. Yeah.
So, what would you describe your like style as? Do you prefer like do you prefer a swing trades? Do you prefer long-term stuff? Are you risk averse? Are you like the young guy who wants to kind of press it and go for it? Like who are you?
I would say I'm the young guy who likes to press it, size very high conviction views, very big, and but yeah, not a swing trader. So some things I own for a long time, other things I'll like sell options against certain positions, and not even against, I own X security, I'm selling options against X security, but like X security benefits in the following ways. So I can get an exposure to like a macro asset that, if X security does well when Y goes up, or, or X security does well when Y sells off. So I'll sell puts against Y because I own a ton of X.
So, how do you think you deal with, like, let's say you have some positions on, um, you have a pretty strong case personally. Have you felt the butterflies flying around when somebody comes in and gives you a real case against your positions? How do you kind of deal with that?
The current position that hasn't really happened yet, and I've actually been struggling to find the bear case. I'm like, I want the bear case, and I just can't. I'm so bullish that it scares me. Like I can't find the bear case. But yeah. Let me think back to certain views. I've never had a vehement agreement with people on a certain name, and I also feel like when I've been very confident about a certain view, it's like if someone disagrees with this, they'd be an idiot. Like a certain name that it's like, I think this stock is going to zero, and it's just like, I would never say that about Tesla or something at the short list. Like, no, like they don't have enough money, and it's like, it's in the filing, like someone like there, it's like, yeah, I mean, if someone who I really respected would have disagreed with me, definitely, but I feel like they probably wouldn't have. But no, I feel like you got to search out for the bear case, definitely, and that's important.
Yeah, it's a tough thing, right? Because I take in a lot of this information, and over the years, I've personally had to like take a step back and be like, what am I trying to get out of these podcasts, these books, these Substacks, these articles? Like, I'm just getting showered with like ideas, bear cases, bull cases, like really good. People are really great at selling like the next 6 to 12 months. And
Yep.
there was
Yeah.
just time where I was personally just like, fuck, like I can't make any correct decisions or have conviction on anything because I hear such a good case here. And I'm like, okay, I can get on board with that. And then I like 2 weeks later, I'm like, wait, I'm like completely on the other side now. So it's really hard to filter through this information. So how do you think people should best deal with that? I have my own opinions on that, but like you're in the mix there with actually pumping this content out. Do you have any suggestions on how we should kind of intake all of these opinions and kind of like start to refine it, refine it?
Yeah. Don't make an investment decision that you heard on a TV or a podcast or a newsletter or a sell side piece of research. Like that can cause you to do your own analysis. And oh, I heard about this. And actually, the name that I'm like the most bullish on, I actually heard about it on Twitter and I just bought it. Like that's incredibly dumb. I've done my own analysis, so people should do their own analysis. And yeah, I mean the macro circuit of people say they think interest rates are going to go up, they think interest rates are going to go down. That is a really tough business. I mean, just look at macro hedge funds like returns over the past 40 years since inception. I mean, hedge funds in general, like don't do amazing, and macro hedge funds, like I don't think they've done amazing, and those are like the smartest macro minds. So obviously you have that, George Soros shorting the British pound, and you have some hedge fund managers last year having some incredible returns. And I actually feel like I was on the right side of that just as a podcast. Like I was interviewing a lot of people who were like, yeah, interest rates are at 0 and they're headed to 5, and that's going to have big implications. Like mathematically, bonds will be worth less, and like stocks may be worth less too. But like I don't think that people should make investment decisions on what they hear unless they do their own analysis, and they should be aware that even their own analysis about macroeconomics is very tough. Like I'll be honest, I was very at the lows. I was pretty quite bearish 2022. I was very bearish at the lows on okay, so now it's just me talking, but that's fine. I'm talking to myself.
I got you.
Okay, you're here. October 2022, and I didn't turn bullish again until like February. And if am I supposed to be the guy who has all the answers? Like people shouldn't be listening to me, and they shouldn't be listening to my guests unless they for their own like in portfolio management. They should listen to it, and it's interesting, and I interview very smart people, and it's thought provoking. But like, I talked to someone in October 22, and they were bearish, and they've gotten destroyed. I mean, they were wrong, and I've talked to a lot of people who are right. And it's not that the people who are right are so smart and the people who are wrong are, idiots. It's just, it's the next time around, I'm sure the roles will be reversed. Like, if you're smart, if you're right 55% of the time, that's a pretty good track record, and part of it is knowing when to size it large, when that's the real skill. Like, I feel like.
Yeah. Well, you're doing a great job at balancing, because I'm like, sometimes I turn on this podcast, I'm like, oh, like look who's coming back on after 6 months of not being right. But you've turned into a proper Switzerland man, where like I can expect Jack's never gonna he's never gonna needle him or something.
So I don't needle people, but I do get them to acknowledge that they were wrong, for sure. And I mean, I don't even get them to acknowledge. I just say you've been bullish on bonds for 6 months. 6 months ago, it was at 3.5%. Now it's at 4.7%. I just say it for the audience. So like, I don't, they should know the background.
Yeah. Like like I watched you with Alfonso the other day, and, it's just interesting when you hang around this space enough, like people kind of go away for a little bit. Maybe they don't post as much or whatever, because I can't imagine kind of having a huge following and getting calls wrong. You've seen that with plenty of big accounts. And it's because people are just so savage out there, and, they don't understand the what you just kind of referenced 5 minutes ago about the fact that like they're going to have plenty of wrong calls. Right. But one of the problems is like people are often paying for their advice or implementing it wrong, or both. And, once you fuck with people's money, all of a sudden, it's just a risky environment out there.
Yeah. And like, I'm not going to talk about anyone in particular, but like, let me just say, hypothetically, let's say I was like an investment strategist, and my own call, I had like 5 calls going into 2022, and 4 of them would have been right. So number 1 was like, I was short, I was short unprofitable technology stocks. Number 2, I was long oil. Number 3, I had a yield curve flattener trade on, so yield curve was flattened. Number 4, what's something that worked out in 2022? Short stocks and short the VIX, or something like sophisticated. I had 4 calls that just I nailed it, and then I had a 5th call that was I was bullish bonds. Like that's the reality of my portfolio, and maybe the strategy I was giving to like clients who were subscribing to me. And again, obviously, I do not have like a paid service. This is just hypothetical. But if I had been on Twitter talking about I'm buying bonds, like people would know me as the long bond guy, and they wouldn't know my 4 other good calls. You know what I mean? So there's a perception of people's calls versus what are the actual calls, and that's, people maybe could say, oh, that's my fault for posting so much about how much I love bonds and not posting enough about the more sophisticated trades. And maybe that's a fair criticism, but I'd say I have an advantage in terms of there's a structural advantage in the same way that like it's better to be, as a business, to be a gold royalty company than a gold miner, just for a variety of reasons. Like it is, I have fewer downside risks to my reputation, I feel like, than people who are like, I'm bullish this, I'm bearish that, because they can make 9 calls in a row, and then the 10th call, people will be like, this guy doesn't know anything. And like, I mean, there are people, obviously, I'm not going to name names, who I've marveled at how many times they've been right in a row, like 10 times in a row. And then they get one call wrong. And I'm like, this guy, who knew this guy who, so, I think that like, it's definitely better to kind of stay Switzerland on my own views, and be biased. So like I do have views on the macro, and I've been wrong plenty, but I tend not to share them. I think the audience can kind of get a glimpse, if I'm interviewing someone and they're super bullish on bonds, and I'm like I'm pushing back a lot more than normal, like maybe Jack likes bonds. And if there's someone's bullish on stocks and I'm pushing back, they're like, maybe Jack's pretty bearish, but I'm not sharing my views because I don't think that's content worthy. I think if there's a guest, if I'm interviewing a guest and my views matter as much as the audience, as the guest views, then I made a mistake in booking that guest, because they're not like a guest should be severely above me in like all regards of their investment framework. So that like my views are not that relevant,
I got you. Jack never kiss and tells. I understand. We'll never know if he's bearish bonds or bullish stocks. We won't know. But yeah, I mean, to your point, I think that's great. I think, and once again, you've done a great job with it. I think from the start to where you are now, it's very poised, and I think guests are comfortable coming on and sharing their views, where they know that you'll give them the proper platform. You might ask a couple of questions that really make them prove their case well. But you're not gonna like by any means like undermine them or something like that.
Yeah, and I'll just say about kiss and tell, like,
what?
So bonds, even though I wrongly thought that the U.S. would be in a recession by now, I was never bullish. Since like 2020, when I was obviously was bullish bonds way too late, but whatever. For many years, I have not been bullish bonds, even though last year I was wrong about having a recession. Obviously, U.S. goes in recession, bonds typically do well, but I just knew the Fed was going to raise interest rates a lot. Or I had a view, and I was following the Fed a lot, and that's kind of how things seemed how they were headed. Now bonds have gone up so much. I mean, you're getting close to 5% on the 30-year. This is also why people shouldn't listen to investment advice, because if they watch a podcast, everyone is going to watch the same podcast, so it's kind of generic, but it's what matters for you. Like, as folks can tell if they're watching this, like I'm a somewhat young guy, and people who are young, they're at like. They should have a small allocation to bonds. I think like the Vanguard 2060 target date fund, it's like 12% bonds. You know what I mean? And only a small percentage of that is like long duration, and some of that's credit, mortgage-backed securities, stuff like that. So like, yes, bonds are, with the benefit of hindsight, bonds are obviously more attractive at 5% than they were at 3.5%. But so like if someone's listening to this and they're retiring, they're a retiree, and they just made a bunch of money on NVIDIA, like, yeah, maybe like sell a little bit of those, take some of those gains. Don't sell all your NVIDIA, but like take some of those gains and like buy long duration bonds to lock in those fixed income. But like, someone who's 19-year-old, then may make sense. And also, even if in 6 months the 30-year rallies 200 basis points, we're at 3%, and the stock market sells off 30%, then the 19-year-old is fucked, right? No, not actually, because they're going to retire when they're 65, and in the long term that doesn't matter at all. And also, even if you nail a call and you're a bearish call to like get out of the stock market and get into cash or bonds or something like that, you beat the long onlys, you beat the Warren Buffetts for 6 months, but then you're not going to get back in, and then your long term you're going to suffer very, very badly. So yeah, I would say I'm trying to have a more long-term investment perspective, and I would recommend the same thing. Although I'm aware that my show is focused on much shorter-term movements in the market and central bank policy and the economy and stuff like that.
Yeah, that's a great answer. Yeah, I've noticed that as time horizons change, I mean, this is just a generalization that I'm maybe coming around, but like for me, right, I'm a day trader, so who thrives in volatility. So like, there's an inherent like baked in the cake bias of me wanting things to be very volatile, which generally means things going down, right? So like the deep subconscious of me is like, I want the world to fall apart. I want like 40% down move in stocks. I want illiquidity limit down so that I can like take advantage on the way down, slide it all in on the way up, whatever.
So is that like
But
short term, just to
as
get a
you
sense of the strategy,
expand,
like short term trend following, like if it goes down 1%, you short it, and then it goes down 5%, you short more, like that kind of stuff?
no, I'm just like an order book, order flow guy. So like I'm tick for tick. Like I'm watching oil go down all day today. I'm just trying to find different opportunities to short it in different areas. And then whatever, if I find a level that I like, maybe I'll just buy it back for a short-term trade, and then I'll flip back short because I think the trend is now counter the narrative or whatever. So I'm very much like a doesn't matter what direction, just like give me volatility, take out as many algos as possible, and let me play with the emotion. That's where I thrive in markets.
But how do you not get screwed if you short oil and then there's a lot of volatility, but it's to the upside? Like you just have.
Well, I just have good
losses?
risk reward, right? Like
Yeah.
I'm looking for spots where I'm risking 10 ticks to make 100 or whatever, right? And I'll be able to take a few shots at that. Like oil, I've been short at different moments, probably 10 or 15 times over the past 2 weeks. And, 4 of them worked for decent winners, 10 of them got stopped out. And like in the end, I might be up a little bit after today. So like I'm just kind of trying, like as long as my conviction's still there for the opportunity. But I'm just very good at managing my risk, right? I'm not just like, oh, I'm short oil, like it's gonna go down. Right. Like
the weakest part of my own investing. Like I think that idea generation, like I'm thinking about a lot of ideas, and maybe some of my ideas are even not even that bad, or they're good ideas. Like idea generation is probably like more a stronger view, but there's idea generation, there's actual like trade execution, risk management, then like I guess portfolio allocation. And I'd say risk management is that's really important, and that's something that I don't know a lot about. It's like even if you enter a trade that has a positive risk reward, what do you do if it goes up 10%? What do you do if it goes down 10%? Like I feel like that's an important question. And if you're actually trading and not investing, but like because if you're investing, it's like I'm buying this forever, and then I'll sell it maybe in 3 years if and when it's up a lot. But and I think it's overvalued. It's over the thesis has over realized itself or whatever, or something drastically changes. But like, yeah, your style, I don't know a lot about. And so do you always have a stop loss order in your target?
I generally do. But I also have an idea of what I want out of it, right? Like I have an idea of what I'm looking for if it goes in my favor. I often think people think about the downside a lot, but they never think about the upside. It's like take crypto for example, right? It's like the epitome of like hope you get on sides and then it's gonna moon, right? Everything's gonna go to $1 or whatever. They don't think about like upside, but that's because they don't really have an idea of like their general goals and what they're trying to achieve. Like it's funny you say that like it's not your strong suit. Well, what you do is like my absolute weak point, right? I don't necessarily know how to dive into a specific security or area and really go deep and figure out how to confirm what I think I know. And I also am so short term after 10 years that it's really hard to just be like, God, just get out and just like let it do its thing over multiple years. Years is a long time.
Yeah.
You know what I mean? It feels like so much happens in years that like to just do nothing is like that feels impossible to me. Right. Whereas to you, it's like, I did my work, set it and forget it. I'm going to go back to doing my podcast.
Yeah,
like,
exactly.
It's just funny how it works.
Your style sounds like it works for you, and I don't think I could do your style because it's like a full-time job, and I have a job, as you say, podcast.
Yeah, so I mean that's the whole point of like this podcast, right? Is to be able to like first of all, identify who you are, what you have to spend time doing, how much money do you have allocated to even play with, and like what are you good at, what are you bad at, and kind of then you go from there, right? Like kind of reverse engineer like with yourself and then figure it out. Like you're right, this is my bread and butter. So like now my whole job is like where are my weaknesses outside of that, right? I'm doing the podcast, I'm talking to more people, trying to learn more. I listen to things like yours, I read articles because I'm trying to improve my like like what do I do with the money I make short-term trading, right? Like I have to kind of do something with that. So that's where I then come into my
You
weak
can't you can't just
point,
use that to
right? Like,
size up.
well, I can size up, but like I use, I work for a firm, right? I use funds, right? I don't use my personal money to then
Yeah,
size up my personal money. And like
I gotcha.
I trade with firm money, and then I get paid out when I make money, and then I have to do something with that money. It
Yeah,
doesn't like go back into the market. So I need to either invest it myself, real estate, whatever. Maybe I take it to Vegas and I play some poker, Jack.
yeah.
I'm guaranteed to lose there short term.
Are you? I don't know. You're a pretty good player, right?
Yeah, I like to think so, but it seems like every time I go to Vegas, I just dump like 4 or 5 grand, and I'm
Well, that's
like,
because
what
you don't need
happened,
it.
man?
As
This
if
game's
you
hard.
have the skills to be good at poker, but emotionally you just don't need it. And you know what I mean? Like there are probably poker players who are at a casino right now who have a much better track record than you or I would if we went to the casino. But you definitely know more about poker than they do. But they're just so like they're just grinding it out. You know what I mean? In the same way that like you can have all these theories and you're wearing the European men's shirt where you got all the thing and you're talking about the macro and the ECB, blah 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 blah. But it's like where are your returns, bro? Like
I don't know, man. I think you underestimate how badly I want it when I play poker.
do you knit it up?
Well, so there is definitely a big part of me that it's one of I've talked about this before. It's one of the reasons I failed at poker is because I let ego get in the way of just balanced strategy, and that's why I've actually thrived in trading more is because there's not a jack across the table from me. There's not a European in a hoodie. It's just me versus me versus the cocoa market or gold or whatever
Yeah.
I'm trading,
You trade everything, not just like
What's
stocks
that?
and
Yeah, and right now I'm telling you, Jack, a lot of things are moving. And it's really
yeah.
interesting
So
there.
what's moving?
Okay. So today, I mean, bonds has been obviously pretty fun to watch, but I tell you what's interesting is like I've seen bonds when they're illiquid. They're not illiquid, man. Like this has been like a
Yeah.
fairly controlled, and I know it's fast in the grand scheme of things, but like it's not. Like I've seen, over the time I've seen when treasury markets go illiquid and they move and they gap, like they're
Yeah.
fiery.
Without
These
the
are
experience of like
tricky.
trading treasury futures in March 2020. So I don't have that experience, but like just looking at historical levels of volatility, I think like the 10-day realized volatility for TLT ETF that I know just for the audience, like 30 year long duration is like 18. That's high volatility, but like in March 2020 it was like 60 or 70. So yeah, it's an orderly sell-off in the same way I'd say 2022 was a somewhat orderly sell-off in stocks. And the VIX you didn't have the VIX go to 70 in 2022. It was not a market puke.
No, it did not. Yeah. That's a hard market for me, honestly. Like um a market that just stair steps down, in an orderly fashion. It's like the worst of both worlds because you're generally losing in a lot of your investments, and then I'm not necessarily finding volatile opportunities in the market to take advantage of. So
Mm-hmm.
2022 is really weird. Ukraine provided some interesting opportunities for a little while. But yeah, 2022 and 2023 have been odd years. I'll admit I'm still trying to figure out like how markets are going to really act moving forward. It feels like I tweeted yesterday. It feels like they're getting the speed wobbles. Like, do you know that on like a bike? Like where your handle starts, you're going so
Yeah.
fast and the handle starts wiggling, but like you're not falling yet, but you feel like you're gonna fall.
Yep.
It feels like we're getting the speed wobbles everywhere. And it's like, what's going to happen? Are we going to catch it and like regain our composure,
Yeah.
or are we just going to crash?
People talk about a market breaking, and that is such an imprecise terminology that like no matter what happens, unless like everything just grinds higher, you could say like, oh well, that broke. Oh well, that broke. Even though, I think you gotta make it if you want to make a prediction and you want to make money in the market, you gotta be like, no, I think the VIX is going to go to 40. I think this sector is going to sell. This very economically sensitive sector is going to sell off. Like high beta stuff are going to sell off a lot. Bonds are going to like rally more than stocks. Like that's what you would see, and we haven't seen that yet. But I don't know. I mean, what are your market views right now, James, on stocks and bonds?
I would say I've lost my bias for now, and I've like reached the stage of just acceptance. So I'm trying to be there in the game, but like not forcing plays, because I feel like
Yeah, that's important.
the longer you go, without feeling like you have like palpable control over what you're doing, the more I personally will start to force things, right? Because as time goes and you're like, hey, this is my job. My job is to make money. And if I'm going month after month with not making money, I start to think I need to do more.
Yep.
And I just talked to Jason Shapiro yesterday.
Yep.
And one of the powers of like having been in the markets for a long time and seeing regimes shift, and like maybe you've made some money, it buys you time and patience to be able to wait for the fat pitches, or wait and not force things. And I feel like even I, after this long and having patience and having time and having the money and all that, I still feel like I got to do something, day in, day out. I feel like and look, when you have access to like 60 different products or commodities or futures markets or whatever, I can find you a story right now in like any product. I'll
Orange
pick
juice.
Yeah, right. Short it. Fucking, yeah. It's up too much, right? Like I could probably go into that order book or that calendar and just be like, this looks like a relatively good risk reward spot. Like, makes sense. Everything else, like the squeezes, no pun intended, in like oil might be over, the dollar might be done for a little bit. Maybe we get a little relief. Oil's gonna drop, or orange juice is gonna drop. Like I could just come up with some bullshit.
And you want to have a view, and like that's when you get into uranium at the highs, something you don't know that. Like, you know what I mean? Like,
yes.
And yeah, I mean, I observed something. It's weird. Like I get into it, and then it just pains me. It's either goes down, or honestly, more often it just does nothing. And then I'm just like, oh, I want to sell this to generate cash to enter a new idea. In the Wolf of Wall Street movies, like you get some, you get a new brilliant idea, like I get a new brilliant idea, and then I sell the thing that I was so excited about 6 months ago, 10 months ago, to buy the new brilliant idea. And then that thing that I just sold or covered, it rallies, or if I was short it tanks, I mean, that's happens. Like I've shorted stocks and lost money shorting it, and then like a year later it's at a few pennies, which is pretty brutal. But as you know, like markets are brutal.
Yeah, it just has a funny way of, and it's funny when you say, because we've all done that. Especially that last one where you're like, you get excited about something, you get a thesis, maybe you watched a bunch of stuff and like you buy into it, but it hasn't really like moved or whatever, and you have that new shiny object that comes in 4 months later. So you're like, well, I need capital, so I'll take from that thing that hasn't moved, or maybe I'm down a few percent on or something, and I'll go into. And it just has a funny way of like pressing your buttons in which the new thing won't work and the old thing will work. And like you said, that, and that's important, is that feeling you get, like that gross feeling you get when like you buy, like, all right, uranium broke out, right? URA or whatever the fuck it is, broke out. It's at $28. All of a sudden you start seeing the uranium videos pop up. The supply is non-existent for like 30 years. Like, China's building all sorts of power plants all around the world, whatever. And you buy in at 28 and it goes down to 26. That gross feeling is like, that one's one you really got to watch for, because I'd prefer to have the gross feeling of having bought into URA at the bottom of its like range that it had been just like sitting at for a long time, and feeling scared because I had this really good conviction on uranium and it hasn't moved. Nothing's really happened and it feels scary to enter. This is back at like whatever, $20 or 21 or whatever URA was at before it broke out. Like that's the feeling I want, is that scared. Not the I bought in at 28 and it's gone down to 26 scared. That's just gross. That's FOMO. That's chasing. That's being second in the race, not first.
Yep.
So there's a difference in those two scared, gross feelings. I want the other one.
Yeah. And uranium, I mean, it definitely could squeeze a lot higher, but it's incredible how much of the cash market is just like speculation. Like so much of the utility companies, they enter like these long-term contracts. So it's like who literally owns the rod? It's like Yellow Cake, Sprott Uranium Trust, like all these speculative vehicles. And then I think that pretty much almost everyone in the market who like knows so much more about it than I do, like agrees that there is a shortage of uranium. But there is a lot of production in the pipeline, so who knows? Like there's a, there's only one royalty company. So it's called the Uranium Royalty Company, but like they have royalties on all these different like 20 different projects, and only 2 of them are actually producing right now. So like if the price goes to $200 or $300, and I think the peak in 2008 was like 140, then like production is going to start happening quick for uranium quick. Now it could be a little bit delayed, but like in the same way that when the price of oil went to $120 and people were like $200, $300, it's like they're going to start producing, in the same way when shipping rates skyrocketed to 10 times their normal rate. It's like, we'll get a paddle boat out there, we'll do anything to ship, any as long as it's made of wood, like let's ship.
I mean, what you're saying is so important though. Like, and this is a good example of somebody who's like maybe a bit better at diving into a sector that they're interested in, right? Because I don't know any of that stuff. I just see like a chart and a breakout or whatever. I don't know that like some huge entity could come in there and, having been long, just dump it on your face and you could lose 40%. Like I don't personally know that. I do know that commodities tend to have a knack for, hey, if demand goes up enough, they figure out a way to produce more of it.
Let's say your level of knowledge, you're saying that it's level 1. Maybe you're being humble and you level. I have level 2 knowledge of that industry, and not uranium, but in oil. Like I feel like it's level 10 level fundamental analysis that makes you money, and sometimes level 2 can be worse than level 1. You know what I mean? Like a little bit of knowledge can be dangerous, is what I'm saying.
It's the middle curve theory, right?
Yeah.
You're either dumb or a Jedi. Yeah, but it's at least good. Like when I hear you say that, I'm like, okay, well, I would want to talk to Jack when uranium is at $40, because it seems like you've played a couple scenarios through your head, right? You've seen this happen before, maybe in oil, whatever. You understand the factors that might come into play when it comes to supply. So like, you're not just going to get overwhelmed by the emotion of price go up, right? You're going to be like, okay, price go up. I knew that could happen. Is it still the case that I thought before where supply could come on, or this is happening, or this might, you're able to think in the chaos, I guess, a bit more because you've done a little bit of preparation, right?
I started digging into the uranium market. I mean, very level shallow analysis for a few years now, but like I started doing a little bit more intricate analysis literally a week ago. So I know very, very little about the uranium. Oil, maybe a little bit more. I mean, like I feel like if oil went to $200, there's definitely a circumstance under which it's a short, but you got to do the work to confirm that it's that, or to have a high reason of confidence that it is that environment. Like if oil goes to 200 and it causes a recession on the demand side, so demand's going to go down, and on the other side, supply is going to go up. Like the cure for high prices is high prices. But if there could be an inelastic buyer, like bonds, a perfect example. Bonds are actually very cheap. So, they're somewhat cheaper now relative to history, a lot cheaper. But that doesn't mean that like institutional investors are going to buy them. Like institutional investors could buy some things that are really overpriced and not buy something that is much more reasonably priced for institutional reasons. Like, I mean, you've worked at a big financial firm. Like I really haven't, but like, it's like, you're going to get, no one gets fired buying bonds when yields are at 1%, but when yields go to 5%, suddenly they're risky, even though they're clearly not less, they're much less risky because you're getting paid. And, if interest rates go to 7%, you're still getting paid that 5%. So you're going to lose a lot less than if they went from 1% to 7%.
Bonds are so confusing to me because I just see like, yeah, you're locking in something like take the long end of the curve or whatever. When it comes to these people, like 30 years is so long. I guess it makes sense to me that pension funds and all that, because it's just a dynamic, never ending thing. But for like the price sensitivity of it for anybody that's what more short term, it has to be like such an important factor. It's tough to me.
I think sort of, now because we're 40 minutes in, I'll give the audience a little bit of if I have a
here
little
it is.
edge, but I think banks have a lot more duration than meets the eye. And I've tweeted about this, but they say, oh, their security holdings, they only own like $3 trillion, and that's coming off a peak of 3.3 trillion. And the last time that interest rates were this high, they came in droves, and banks always buy, and their book is going to reprice. So number one, their balance sheets are shrinking. And number two, okay, actually, and I don't think a lot of people know this, people in the industry know, but is that banks, their securities portfolio is actually not composed of treasuries as the majority. It's actually agency mortgage-backed securities, and that has a different duration profile and convexity profile than treasuries. So that if you buy you buy treasuries at 2% and you buy an agency mortgage-backed, let's say at 2%, if interest rates go to 5%, the duration of a treasury at 5% is actually, I'm embarrassed if I get this wrong, is actually lower. So your risk gets less risky the higher the yields go, because you're getting paid more. But for agency mortgage backed, it's the opposite, and things get more risky. You have more interest rate risk the higher rates go. So it's kind of like, for options, like it's you're like short a put for agency mortgage backs, but for treasuries, it's like you're long an option, kind of. Like in the same way that if you're short a put and then it goes from 100 to 80, you're actually a lot more short. So sorry, if you're short a put, and it goes down, like your delta goes up. You know what I mean?
So you're basically saying that the holdings that people think the banks have are actually potentially a different type of holding that can get more risky as interest rates go higher.
And by risky, I mean exposure to interest rates. So if rates go down, which I think interest rates are probably going to go more likely to go down 200 basis points than up 200 basis points. What's the Fed going to hike 7.5%? Maybe, but I think it's more likely that they go to 3.5%, and but banks already have a lot of that exposure because what they own is basically mortgages. And the reason that happens is because when interest rates go up, no one prepays their mortgage, and mortgage-backed securities have a whole series of assumptions about conditional prepayment rates. And like prepayment rates were in the 40s. So 40% of people a year, I think it's on an annualized basis, 40% of people during a year, let's just say, were refinancing their mortgages or paying back their 7% mortgage to refi to a 3% mortgage. And it slowed down in March of 2023. Conditional prepayment rates flatlined at 3%. So I think the entire financial system was based on a whole series of assumptions about when people would pay their loans, what the time period that those cash flows would go in, and the time flows at which they would make deposits and stuff. And going from 0% to 5.5% on interest rates has totally thrown all those assumptions out the window. And so banks own a lot more duration. And I've done a little bit of work on that. On the treasury side, I really haven't dug my teeth into the treasury issuance. But again, I kind of can outsource my work to people who I respect. So for example, Andy Constant, who does excellent work, Joseph Wang, they say, and they're not just telling me this in secret, they post about it on Twitter and on their websites about how much the treasury is issuing. And you can't do you can't be in the weeds on everything. So I just say, I think there's a decent chance that Andy and Joseph are right about that. I've done my own work on the bank side and bank demand, and that's what So yeah, but yields at 5% are pretty good. So I don't know, man.
When I hear you say things like that, I hear the first thing, from a topical level, I hear the first thing is something that is a little bit maybe harder to price in because it's less understood. And then the second thing, when it comes to issuance, my initial reaction is like, yeah, the market knows. Like whenever I hear something that's like the market probably knows, I start to like just take a step back because I'm like, okay, it does sound like, oh, issuance is coming, blah blah blah, and maybe it is, and maybe it does keep the bear steepening going or whatever. But I'm like, but the market kind of knows. And when I hear you say
Yeah.
something where like, oh, sneaky over here is like, there could be a very large underlying problem that like maybe the general market as a whole is like a little bit unaware of. Like that's more interesting to me. Like hidden risk, the hidden forces that you can't really see. And that's what really like sparks my interest as a short-term trader, because I'm like, over 10 years, the things that have made me the most amount of money have been like exogenous events, right? Ukraine, an Iran missile, a devaluation by China, COVID, VIX apocalypse or whatever it's called,
Yeah.
Volmageddon.
Yeah.
December 2018. That was another one that was interesting to look at in like the environment today. The stocks like waterfall like 20% or something in December of 2018. Those types of things. And when I hear like treasury issuance, it's the next scary thing. I'm like, maybe.
Okay, so I think there's a decent chance that it's priced in now, but we've had a huge puke in bonds, and maybe, I mean, I think the Treasury had issuance had something to do with it, and sometimes things are obvious.
Yeah.
But I mean, I think with the benefit of hindsight, like it's obvious in January and February of 2020 that like this COVID thing was going to go worldwide, and there could be a severe, drag on risk assets. But the market is not perfectly efficient, but it is efficient a lot of the time. And yeah, I feel like with banking stocks, like I feel like their how much money they make on net interest income with changes in the yield curve is knowable, and they report it. And then how much their economic value of their equity changes is also knowable. And I feel like the stock market, those banks do not trade with yields. So like you could say, oh my God, this bank is making more money as the rates rise, and so it should be going up, and it didn't go up. Is it a buy? But it's like maybe the market is making a judgment about everything, and it actually would have gone down if not for the yield move. You know what I mean? So it's very hard to see what is priced in. And then banks, as a general, like every bank is different, and they all have different sensitivities. So yeah, I wouldn't make any statements about like the banking sector unless you're painting with like a really broad brush. The banking sector, painting with a broad brush, does have a lot of duration exposure that people may think that their $3 trillion worth of securities is as much duration exposure now as it was when yields were higher, and they may think it's even lower because yields are higher, but they don't own treasuries; they own agency mortgage-backed securities.
That's why I just, as like an open-minded experiment, I like to think, did treasuries actually puke there? Because again, maybe, or maybe we get a rally, and then just when everybody's finally grab that last batch of TLT they really think they need, maybe then we actually see a real puke.
Yeah.
I don't know. It's hard. You can never really know, and that goes back to the thing with poker. Like I know if Jack went broke at the table, I know if he puked his whole stack and like left the casino and he's not there anymore. But I don't know if a bank pukes or like a hedge fund blows up. There's rumors.
Yeah, and people on Twitter who are like anonymous people on Twitter, they don't even show their face. Not that there's anything wrong with that in theory, but like are like, I'm hearing that pods are blowing up. A pod blew up today. It's like there's no accountability at all. Like it's not, like I know people, trash journalists, but it's like if journalist has a scoop, like this bank is going to fail or this is not going to happen, and it doesn't happen, like there are repercussions to that person's reputation. But if you're just some anonymous little like hedgehog on Twitter, and like you say, a pod is blowing up, then people forget about it. You know what I mean? I guess the reputation of your Twitter account is blown up, or maybe not. I don't know, but yeah, I feel like if I was someone who made calls all the time, I would like to own up. I'd be like, look, I was wrong here, and then move on, and not always be like, yeah, I was wrong this day, but just like admit it, once, which a lot of people do. But again, I'm a gold royalty company, and that I don't make public calls, which is an advantage.
Yeah, man, it's a great point. I really appreciate when people admit they're wrong and can move on, and they're willing to they're not only willing to stick their neck out there, but they're very willing to be like, look, that was off, and here's what I think I got wrong. But too many people are shapeshifters out there, and really to meld, they can. You could be like, 6 months ago, I could have sworn you said something that I don't think that happened, but now it sounds like you've been saying Q1 of 2024 now, but I can't really tell because they're just like always bending a little bit here and there. And
yeah, I hear that. There are a lot of people who are institutional sell side people who, I mean, I've interviewed a handful of people like that, but most of the people I interview are not like the head strategist at so and so, for, you know what I mean? And sometimes I see them on the TV, and I see the journalists like being like, wait, haven't you been bearish for 4 years? Like, what, you know what I mean? Like they're just selling the product to their company of that I'm a smart person who should still be employed here. That's the real product. And often I, a sales guy I know said, often into the internal politics of a bank, like more important than being a guy who sells a lot of bonds is being seen within the firm as a guy who sells a lot of bonds.
That's good. That's good. There's no hiding at like a trading firm. You know what I mean? Like,
yeah,
you either have P&L or you don't. Yeah, so that's kind of cool. There's no smoke and mirrors there. But all right, Jack, it's been 50 minutes or so. Thanks for coming on. Is there anything you're excited about moving forward? And use the opportunity to tell people where they could find you, because I don't know if you have anything out there that people might want to watch, but I feel like you do.
Yeah, so people can find me on Twitter at JackFarley96. The show's forward guidance is available, Apple Podcasts, Spotify, and then the YouTube channel that it is released on is called Blockworks Macro. And yeah, I appreciate you giving me the chance to come on, share my views, my process, and let me just take a look at what I got coming down the pike. I mean, cool. So we're recording this on October 4th. I got a lot of really exciting interviews. But by the time this is aired, my interview with Lynn Alden will have aired. I'm talking to David Cervantes, who's been very bullish on the economy, which has obviously worked out well. But maybe he's getting a little bit into bonds. We'll see. Then a conversation on the economy and the bond market with Mike Green and Bob Elliott. That should be great. I'm talking to Marco Popic. I'm talking to Joseph Wang and Claudio Borio, who's the chief economist from the Bank for International Settlement. So he's a very, very big deal. Excited for that. And then bank earnings season kicks off next Friday. What is that? That will be the 13th, I think. The week after that, I'm doing 2 banking interviews, one with Chris Whalen, and then one. I'll keep that with another little bit of a surprise. But yeah, a lot to be excited about. And I actually have Forward Guidance has a very a sponsorship agreement that I'm really excited about that will be coming out in the next few months. But yeah, this is a company I love, and I'm really glad to be working with them. So.
It's FTX 2.0.
Never.
All right, Jack, thanks for coming on, and hopefully some people got some really interesting stuff out of this. And again, guys, go check out his stuff. It's all really, really great. I've been learning a lot from it, so keep doing what you're doing.
Thanks, James. Talk soon.